Okay, what we're going to cover today, I'm just going to do a bit of a general summary about the economic conditions, I guess, but also just a general summary of what the budget's all about. Then we're going to have a look at how it affects individuals, then business taxpayers. We'll have a bit of a look at what's happening with superannuation and retirement measures. Then probably the last thing we'll do is just have a look at a raft of other measures that may or may not affect people that are watching this, but just for completeness, I guess, we'll just have a look at those measures as well. And then we'll have time for questions at the end. So, as I'm sure everyone's aware, this is the second budget for the year. The previous government presented a pre-election budget back in March. This is the first budget from a Labor government in nearly 10 years, so the last one was back in 2013. There's a focus on cost of living relief measures, but also at the same time a desire to keep inflation at a controllable level. There's no new taxes, but there's a focus on multinationals and also compliance measures, particularly for individual taxpayers. So that's how the government are looking to increase their tax collections. No changes as expected to the legislated stage 3 individual tax cuts, but we'll talk about that in a bit more detail a bit further on. So a bit of a glance at the economy. So inflation last year was 6.1%. It's forecasted that it will end up being 5.75% for the current financial year, but it's expected to peak at around 7.75% in the current quarter. So yeah, it's certainly going up before it comes down. And it's not expected to return to Reserve Bank targets, which are between 2 and 3%, until well into the 24-25 financial year. Government is predicting 3.25% growth in the current financial year, so a little bit down on the previous year, but yeah, still some growth there, which they're expecting. The employment rate is at close to 50-year lows, and is expected to hold at around about 3.75%. Deficit is lower than was originally expected. That's generally due to high commodity prices, which are not really in the control of the government, but it's expected to increase to over 51 billion in the 24-25 financial year. So it's a pretty scary figure. But that's sort of on the back of cost of the welfare programs, which the government is going to be rolling out, and also indexation of those welfare programs. So looking at individual taxpayers, so what has been announced in the budget is around the boosting of the parental leave payments. There's also a plan for cheaper childcare costs. There's been no extension of the low and middle income tax offset past the 21-22 financial year. And as I said before, there's no changes to the legislated stage 3 tax cuts. So boosting the paid parental leave. So there's going to be changes introduced, and these will come into effect from the 1st of July 2023. The parental leave program will be much more flexible than it currently is. And it's also going to be increased. So from the 1st of July 2024, the scheme will be increased by 2 weeks, and it'll be increased be increased by another 2 weeks in the following years until it gets to 26 weeks from the 1st of July 2026. So paid parental leave is currently limited to 20 weeks and can only be paid to the primary carer. These reforms will provide a lot more flexibility so that either birth parent can claim the payment. as well as non-birth parents. They can also claim the payment provided they're eligible. There will be further flexibility introduced such that the parents can claim the payment concurrently, or they can share the leave payments. For instance, on the current 20 weeks, they could take 10 weeks each, or alternatively, they could take a lesser number than that and sort of share some of the leave together. What the policy, I guess, is to just encourage parents to share the primary care of newborn children. There will also be incentives built into the scheme to encourage, both parents to that. So it may be, while the parental leave is going to be 20 weeks, there may be some disincentives, if you like, if it's not being shared between the two parents. Cheaper childcare. This will start from the 1st of July 2023. There's going to be an increase in the childcare subsidy maximum rate from what it currently is. It's currently 85%. It's going to be increased to 90%. And that maximum subsidy rate will be paid where the family income is less than $80,000. It will scale down from there, but the upper threshold has also been increased. So the upper threshold is going to be $530,000 per family. So certainly there's going to be lots of families out there that are going to get some childcare subsidy, if not the maximum amount. They're also going to maintain the higher rates of 95% where there's multi-child families, and this will sort of continue until such time as the oldest of the children ceases care or turns 6. Again, this measure is designed to ease the cost of living for working families and reduce the barriers to greater workforce participation. Just on the reduction in the subsidy rate as you go over the 80,000 of family income, the rates will reduce by 1% for each additional $5,000 in family income. So the low and middle income tax offset, as I said, that has now ceased. It ceased on the 30th of June 2022. I guess some commentators were thinking that maybe it would be extended, but it clearly is not being extended. The low and middle income tax offset was $1,500 in the 22 tax year for individuals where their incomes were below $126,000. There is still going to be a continuation of the low income tax offset, which is up to $700, but this phases out for incomes above $37,500. So stage 3 tax cuts. As I said, no changes to these, which was as expected. The main reason there wasn't any changes is because they don't kick in for nearly 2 years, so that the government didn't really need to do anything about it. As you can see on this table, what's going to happen with these changes which have been legislated is that there's going to be just one marginal tax rate between incomes of $45,000 and $200,000. Currently, there's 3 different rates until you get up to $180,000. So the 45% bracket isn't going to kick in to $200,000, but there's going to be just one bracket between $45,000 and $200,000. So there's been a lot of commentary around how these changes are just going to affect, just going to help billionaires, and there's been a lot of pressure in the media on the government to change these tax cuts. As you can see from this table, the main effect is going to be on sort of low and middle income earners between 45,000 and 180,000 that are currently subject to marginal tax rates of 32.5% and 37%. Sure, the people on the top marginal rate are going to get a benefit as well, but it's really going to be felt in those sort of middle income earning categories, I think, more so. Also, the reduction of the marginal rate for those people to 30% is going to significantly reduce the tax disincentive of bracket creep. So as you earn sort of additional dollars over 45,000, they're going to be taxed at 30%, not rates up to 37%. As far as what's going to happen with these tax cuts in the future, nobody really knows at the moment. But you would expect that maybe the government, as it was an election promise, they may be looking to take some sort of plan to the next election, and not do anything about it until such time as they're in a position to sort of be in an election campaign, I guess. I guess one sort of option they might be looking at doing is maybe increasing marginal rates for incomes above 200,000 rather than playing around with the marginal rates which they're looking to change. Or they may look at some sort of temporary budget deficit levy to raise funds to help with the deficit. That's been done in the past, a few years ago now, but that may be something they might look at. But yeah, I think that there is definitely going to be a lot of resistance from the government in actually backing down on their election promise. So business taxpayers, there's no extension to the immediate expensing of assets. I haven't seen much about this in the media at all, but yeah, it certainly hasn't been addressed. They currently cease on the 30th of June 2023, so obviously the government's still got a bit of time to do something around that. But unless there's changes announced at a later date, these immediate write-off of assets that businesses are acquiring are potentially going to revert back to $1,000 as being the maximum immediate deduction you can get, and just get depreciated at normal depreciation rates. So I don't think it will go back to $1,000, but yeah, it remains to be seen what's going to happen there in the next 6 months or so, I guess. There's been some more announcements around COVID-19 grants that have been declared in the past. The government has the power to make these non-assessable for businesses that have received them, but they have to actually specify, the Treasurer has to specify which grants it is that aren't assessable, otherwise they would ordinarily be assessable. The only ones listed are Victorian government grants and Australian ACT government grants. So yeah, nothing in there, nothing changes as far as grants that have been paid from the other states and territories. There were tax cuts that have previously been announced around electric vehicles. Just note that it includes plug-in hybrids, so it's not just fully electric vehicles that can't use fuel. It also includes hybrids that provide you can plug in and recharge the batteries on those vehicles. It only applies to vehicles that were first bought after the 1st of July 2022. So if you're in that category, there's no FBT on those vehicles if they're provided as a benefit by employers. And there's no import tariffs, which I think are currently around about 5%. The threshold is the luxury car tax threshold, which is currently $84,916. So the on-the-road price has to be less than that amount for it to be eligible. There was also an announcement around the reversal of self-assessed effective life for depreciation of intangibles. So the sorts of thing we're talking about is patents, copyrights, registered designs. For many years, there's been, in the legislation, there has been rates which you have to apply to, maximum rates that you can apply to depreciate these types of assets. There was proposed by the previous government that this could be self-assessed, so that businesses could work out how long those intangibles are going to provide economic benefit to their businesses, and then depreciate them over that period. But the current government said that's not happening. So it's just reverted back to the current rules. There will be grants that will be provided to small and medium businesses to fund energy efficient equipment upgrades. There's really no detail on this, but essentially what they're doing is looking to fund or funding that will support studies, planning, equipment and facility upgrade projects that improve energy efficiency and reduce emissions. So not a lot of detail on that, it's just a bit of an announcement. There's also an increase in the heavy vehicle road user charge. So for businesses using heavy vehicles on the roads, freight companies, etc., the road user charge is going from 26.4 cents to 27.2 cents per litre from the 29th of September. So it's backdated about a month. So while that might not sound like a lot of money, it's I would imagine if you're running a trucking company, it's a significant cost increase. And what that's effectively going to do is it's going to reduce the fuel tax credits that you can claim on the use of those vehicles. So next we'll have a look at measures around superannuation and retirement. So the first thing they're doing is, and this has already been announced, they're expanding the eligibility for the downsizer contributions. So that currently that's 60 at age 60 you can take advantage of the downsizer contributions. It's going to be reduced to 55 years, and it will apply from the start of the quarter after this legislation receives royal assent. So what the downsizer contributions are, they're a one-off post-tax contribution into your superannuation fund of up to $300,000, but it has to come from the sale proceeds of your home, and it has to be your main residence. So if you're selling your home and going down into a unit or something like that, and you want to put some of the excess cash that you get from the sale of your home back into your superannuation, you can do that, and it won't be counted towards your non-concessional cap. So it'll be allowed to go over and above what other non-tax, after-tax dollars you've put into your superannuation fund. The policy goal of this measure is to encourage seniors to move to smaller dwellings and free up housing stock for younger families. But it also allows individuals that are close to retirement to maximise their superannuation benefits so they can live off their superannuation in retirement. Also some incentives that have been announced for pensioners. So people on Centrelink pensions, where they downsize their homes. There is an asset test and an income test that applies to all Centrelink benefits. What they're doing is for the asset test, where you've sold your family home, but you haven't done anything with the proceeds, you're just sitting in a bank account or whatever. So it's sort of still sitting there as an asset included on the asset test. It will actually be exempted from the asset test. It was previously exempted for 12 months. It's now going to be exempted for 24 months. So you've basically got 24 months to decide what you're going to do with the cash. Also around the income test, income test will still apply. The deeming rate will still apply to those funds, but it will be the lowest deeming rate under the rules of 0.25% per annum. And that will apply to the home proceeds where the home was sold up to 24 months. For up to 24 months. So just moving on, again with superannuation, there were some announcements the previous government made around relaxing the residency requirements for self-managed super funds. These will be delayed. They were to apply from the 1st of July 2022. They're now going to be delayed until the year after the legislation actually receives royal assent. So the government are still going to proceed with them, but they're just deferring them a bit. Also, the proposed 3-year audit cycle for some self-managed super funds will not proceed. So there was a lot of lobbying, if you like, I guess, from the superannuation industry. They sort of flagged concerns of non-compliance because there was a longer period, up to 3 years, where no one was actually going to be looking at the accounts of these self-managed super funds as far as audit is concerned. And there was just a concern that there would be non-compliance during that period. So I guess, and these measures were originally announced back in the 2018-2019 budget. So they've just sat there for quite some time. So the government have just said, yeah, this is not happening. It'll continue to be a required audit every year for self-managed super funds. So just some other measures. I'm not going to give too much detail around these, but just to make sure that you're aware of them. So around international tax measures, there's been an announcement that there's going to be a further limitation on interest deductions under the thin capitalisation rules. So where multinational entities are operating in Australia and claiming interest to related parties, there are some rules that limit how much interest you can claim. So there's just further limitation on that. Also, the government are looking at denying deductions for royalty payments that are made to related parties that are situated in low tax jurisdictions. So again, just stopping the tax collections from flowing out of Australia into another jurisdiction potentially. And there's also going to be increased reporting requirements for multinationals. Just an announcement around digital currency or cryptocurrency. It will be continued to it will continue to be excluded from treatment as foreign currency. So there's been a few countries around the world that have decided they'll treat digital currency as they do with foreign currency. That's not going to happen in Australia. So we're just going to maintain the current treatment of digital currencies, including the fact that they will be subject to capital gains tax where they're held as an investment. There were previously announced measure back 2 or 3 years ago, I think, such that the government was going to limit business cash transactions to $10,000. These measures have been scrapped. They're not going to result in legislation. There's been some changes to the start date for the sharing economy reporting regime. So this is for like Uber and Airbnb. So there's going to be just a deferral of these regimes. So people that are involved in these industries will be required to report how much that they're earning or how much is being paid by other people to them. So it was to apply from the 1st of July 2022. Some of the industries are going to be deferred until 1 July 23 and some until 1 July 24. So it's still on the agenda, but it's just been put back a bit. There was also a regional first home buyers guarantee scheme announced. Not too much detail on this, but basically it's going to be a 5% minimum deposit scheme, and essentially the government will guarantee the balance. It's for permanent residents of regional locations, and they need to have been in that regional location for at least 12 months. So just need to see some detail, I guess, around what's included in the definition of a regional location. But yeah, clearly an incentive to get people out of the cities and back into the regional locations. Increased funding for the tax office. I guess it's fairly common in the budget to give increased funding to the ATO pretty much every year. They're going to be focusing on personal income tax compliance, and also there's going to be an extension of the funding for the shadow economy, or the cash economy, if you like, compliance program. So also the tax officer are going to have a greater focus on collecting data from third party sources, and comparing that income and expenses declared with what's been declared in your income tax return. There'll again be a focus on residential rental properties, and I know the tax officers are actually looking at gathering data direct from real estate agents where possible. I attended the Tax Institute Tax Summit last week, and the second commissioner spoke at that conference, and it's also been announced recently by the commissioner at a different conference, just talking about looking to digitise personal income tax returns. So essentially just setting up systems so that all the information is there, and essentially you don't actually need to do anything. You just push a button and that's your tax return. I think we're a fair way off of that. The information is not available at the moment in any sort of sensible form. What the tax office are looking at doing is sort of talking with business software companies such as Myab and Xero, etc., and actually plugging in directly from business software into the income tax system. So that's something that's probably going to happen eventually, but I think we're probably still a fair way off of that. But yeah, that's certainly what the tax office are looking to do, and they certainly will be looking very closely at personal tax returns, and particularly where there is rental properties with large expenses being claimed. So that's pretty much all I've got. So we've got plenty of time for questions. Adrian, have we got any questions yet?
Not at the moment, but yeah, don't be shy. Ask any questions for Brandon while he's available.
So yeah, so I'll just give everyone a few minutes, I guess. I know it was a pretty dry budget. There wasn't a lot to take out of it, I guess, from a business sense, where I'm guessing that's where most of your interest would lie. Yeah, a lot of the business stuff was around international tax. And yeah, wasn't really too much announced around the business side of things, but certainly if you've got any questions now, or if you think of some questions later on, feel free to contact me. My details are available on these slides and also on the website. Yeah, I'll certainly be happy to answer any questions you've got, and certainly any of your advisors here at Marsh Tincknell, I'm sure would be happy to help you out with any questions you've got. As with all budgets, until we actually see the legislation and it goes through Parliament, it's probably not going to be too much problem getting through the lower house, but always seems to be a fair bit of argy-bargy in the Senate. So some of the details may change once it sort of becomes legislation, but yeah, that's the announcements as they are at the moment.
A couple of questions come through, Randall. One asking about what the changes in the instant tax write-off means for an equipment hire business.
Okay, for an equipment hire business, I'm assuming we're talking about a short-term equipment hire type business as opposed to hiring equipment to a related entity. So currently you would be able to write off all of your assets that you acquire. There's no limit on the amount that you can claim a deduction for. It's an outright deduction if that equipment is used in your business. So yeah, it could change substantially if the government don't decide to do anything in that area. I believe if nothing happens, it reverts back to $1,000. As I said, I don't think that will happen. I think it's probably going to potentially go back to pre-COVID levels, which I think was 30,000 was the maximum contribution. Maximum outright deduction you could claim for depreciation. So clearly, you're still going to get your depreciation deductions over the life of the asset. If you're a small business entity, so if your turnover is less than $10,000, you will be able to pull those assets and effectively get accelerated depreciation on those. But it just means you're not going to be able to write them off outright in the year of purchase.
Just one other question also around the immediate asset write-off. Would you mind just confirming again those dates that and whether they've changed or not over the last couple of days?
Okay, that's stretching my memory a little bit, but I'll do my best. So the dates that changed, so it was around when you first purchased.
Just around extensions of that immediate write-off deduction and whether there's any.
Oh, we're talking about the end date. Okay, so so the start dates are a little bit insignificant now because they're back a little way. The end date is the 30th of June 23. So you have to have acquired and have the asset ready for use prior to the 30th of June 23. So you can't just go out and order a vehicle on the 29th of June because it won't be delivered by the 30th of June. You have to have actually incurred the expense and also have it delivered and ready for use. You don't necessarily have to have paid for it. Obviously, that's going to be the case with larger assets. You will have either had to have paid for it or sort of had finance arranged. But yeah, it's going to have to be delivered by that date.
Perfect. I don't think there's any other questions coming through.
I'll just hold off for a minute or two. But yeah, if you've got any burning questions, let us know. Otherwise, we might wrap it up at that.
One other question's come through. Has there been any talk around the extra tax that high income earners have to pay on super contributions, so the Div 293 related?
Okay. As far as I'm aware, there was no announcements around that, so that will continue. And yeah, I can't imagine any reason why they would reduce the tax. It currently kicks in at 200?
250.
250, yes. So it currently kicks in at 250. So if your income, so it's adjusted taxable income, so you need to add back your superannuation contributions. If that exceeds 250,000, then you are required to pay another 15% on your deductible contributions. So that is, that can be quite a substantial expense. But it's designed to make sure that people that are on incomes of that level are not getting additional benefit, I guess, by putting money into superannuation. It's effectively going to get taxed at 30%. So 15% when it goes into the superannuation fund, and then potentially another 15% if you've got to pay this additional tax. So yes, no announcements around those around that tax. Okay, all right. Well, that looks like that's the end of the questions. Thanks for your questions and thanks for listening to me for the last 40 minutes or so. Like I said, yeah, anything that you want to know, I'm sure that I'll be able to help, or any of your advisors here at Marsh Tincknell will be able to assist you. But yeah, thanks very much for your attendance, and yep, see you again soon. Thank you.
Brett snuck in another question there. If you wanted to answer it while you're still here, Randall.
Okay.
Will they raise the private health Medicare surcharge level above the 90,000?
I didn't see any announcement around that. That's normally just announced at the end of each financial year. So normally that just increases with indexation. So I'd imagine that's still going to be the case. So yeah, so although I don't think the threshold where the surcharge kicks in does get indexed, I think only the actual level where Medicare levy kicks in is indexed. So yeah, haven't heard anything about that. That may be something they'll look at doing. I'm sure, you know, there's going to be all sorts of options the government's going to look at to raise taxes and try to get this substantial deficit down. And yeah, maybe Medicare will be an area that they will look at.
Cool. Thanks again, everyone.
Okay.
There'll also be a recording of the session available, so in case you missed anything along the way.
All right. Thank you, everyone.